While America slept, $100 billion vanished from the banking sector, more than the GDP of some nations. Yet, for most people, the world felt unchanged. The news focused on politics and weather, oblivious to the financial earthquake rumbling beneath. This was no slow burn, it was a sudden, brutal shock. The banks were silent. No statements, no reassurances, just a void where confidence used to be. Bankers and regulators stared at screens asking, how could this happen? These weren't Wall Street giants, they were Main Street's backbone. The money hadn't just disappeared, it was a symptom of a deeper disease. The first domino had fallen, and the rest were teetering. The financial world was about to change forever. The epicenter wasn't New York. It was the Midwest. Heartland Financial, a century-old regional bank, was the first to fall. Known for trust and stability, it hid a dark secret. An anonymous tip pointed to irregularities in its commercial real estate loans. Investigators expected sloppy accounting, but found systemic fraud. Heartland had used shell companies to buy its own toxic assets, masking losses for years. The bank's reported profits were fiction. It was fundamentally insolvent. The fraud wasn't isolated. Another bank, FNB, was implicated. Executives at both banks colluded, trading bad debt to inflate asset values. This was no lone wolf scheme. It was coordinated deception. The discovery sent shockwaves through regulators. If two respected regionals could orchestrate such fraud, how many others were hiding the same rot? The premise of regional banking, safer, more connected, was shattered. The small crack in the heartland was now a gaping chasm. The dominoes were lined up, ready to fall. Trust in the system was evaporating. The financial landscape would never look the same. At the center were two men, Robert Sterling of Heartland and Marcus Thorne of FNB. Both were seen as pillars of their communities, trusted, respected, untouchable. But behind closed doors, they engineered a multi-billion-dollar deception. Their problem: a mountain of bad commercial real estate loans. Their solution: offshore shell companies and a Cayman Islands firm, Viridian Capital, secretly controlled by them. The banks sold toxic assets to Viridian, using their own money to buy their failures. It was a closed loop, fraud disguised as profit. Regulators, distracted by bigger banks, missed the scheme. Sterling and Thorne exploited this blind spot, enriching themselves while their banks rotted. Their greed and arrogance set the stage for collapse. They were celebrated as geniuses, but their empires were built on lies. The fallout would ripple far beyond their own institutions. News of the fraud shattered the fragile trust holding the system together. Investors dumped shares of Heartland and FNB in a brutal sell-off. Billions in value evaporated within minutes. Panic spread. If these banks could hide fraud, who else was at risk? Investors fled all regional banks, triggering a digital bank run. The sector's key index plunged over 30% before the market opened. Larger banks pulled credit lines, starving regionals of capital. The crisis spilled onto Main Street. Customers lined up, desperate for cash. FDIC insurance didn't matter. Fear isn't rational. The wildfire of panic, sparked by two men's fraud, now threatened the entire system. The financial forest was burning. As the crisis unfolded, ignored warnings echoed with new urgency. Analyst Meredith Whitney had called regional banks a ticking time bomb, citing risky real estate loans and lax standards. Her warnings, once dismissed, now read like prophecy. The parallels to 2008 were unmistakable. Hidden losses, obscured asset values, and a breakdown in trust. Jamie Dimon of JP Morgan warned, "When you don't know what an asset is worth, you assume it's worth zero." Regulators had rolled back post-2008 protections for smaller banks, believing they posed no systemic risk. That assumption was now proven catastrophically wrong. The very banks freed from oversight were the source of instability. This crisis was sudden, insidious, a lightning strike, not a slow-motion crash. It was rooted in old-fashioned fraud at the top. The lessons of the past about transparency and regulation had been forgotten. The pursuit of profit had blinded the system to its own vulnerabilities. Now, the cost was being paid. This collapse was the result of a decade of easy money. The Federal Reserve's near-zero rates fueled a desperate search for yield. Banks took bigger risks, especially in commercial real estate. Regional banks, lacking diversification, piled into risky loans. The government's repeated bailouts created moral hazard. Risk-takers expected rescue. When rates finally rose, the house of cards wobbled. Risky assets lost value. Bad loans became toxic. Heartland and FNB's fraud was a symptom of a system-wide disease. The era of easy money was over, and the reckoning had arrived. The safety net was gone. The bill was due. The crisis exposed a dangerous divide. On one side, megabanks, diversified, well-capitalized, strictly regulated. On the other, regional banks, vital to local economies, but fragile and exposed. Their fortunes tied to single sectors, they had nowhere to hide when trouble hit. Regulatory rollbacks left them vulnerable, while giants were protected. Investors fled regionals for the safety of titans, making the weak weaker and the strong stronger. The system fractured in real time. This wasn't just a crisis of confidence. It was a restructuring of American banking. The giants absorbed resources. The regionals bled out. Deregulation had created a two-tiered system, and the cracks were now canyons. The landscape was being redrawn by fear. When the market opened, chaos erupted. The Dow plunged 1,500 points in minutes. Screens turned red. Fear went systemic. Investors sold everything, not just bank stocks. Automated trading accelerated the collapse. The VIX spiked to crisis levels. Volatility ruled. Official reassurances rang hollow, echoing 2008's false calm. By midday, indices were down nearly 10%, trillions in wealth erased. This was no longer just a banking crisis. It was a market crash. Retirement savings and pensions took devastating hits. The pain spread from Wall Street to Main Street. The panic, sparked by hidden fraud, had engulfed the entire economy. The devastation was everywhere. The system's fragility was laid bare. As the dust settles, an uneasy calm prevails. Emergency measures have halted the free fall, but the crisis isn't over. The $100 billion loss was just the first crack in a flawed foundation. The system remains dangerously divided and riddled with risky debt. The fraud at Heartland and FNB was a symptom, not an anomaly. As long as incentives favor risk and short-term profit, another collapse is inevitable. The next crisis may come from anywhere: corporate debt, insurance, or shadow banking. Our interconnected system ensures that trouble in one corner spreads everywhere. The authorities have patched the symptoms, but the disease remains. Remember how quickly confidence can vanish. The events of these days are a warning. The system is more fragile than we think. The next tremor may be the big one, and it's coming.